is what we call the 10-year model. In this video, we will discuss building wealth within a small portfolio and growing your portfolio by only leveraging your own loan. It's a very powerful method of allowing your money to work for you. Well, you just sit and watch it grow. So let's get started. Imagine that you have $200,000 and you want to invest it. You want your money to work for you. You have many options. You could probably buy one medium to medium high-end fix and flip house in a working class area of the Midwest. Or maybe you could buy a few rentals with that $200,000. But what if instead you just bought notes, specifically performing loans? I'm going to show you how you can practically set it and forget it. Let this portfolio grow. If you don't pull out money, at least in the early years, you can achieve exponential growth within the portfolio. In order to keep all things equal and compare apples to apples, for this demonstration, we will assume that we're going to buy the exact same type of loan each time. Sure, we could throw in different numbers and have different types of loans, but that could get very confusing. Our goal is to keep things simple and concise so we can see how the growth works. So we're going to be buying the exact same type of loan every time we need to buy a loan. We're going to replicate this process multiple times. You may start to see a trend as this happens. And by the way, this can be totally passive. Imagine that we have a borrower who owes $45,000 on a house. The interest rate on their loan is just over 8%, and their monthly payment is $386. The term of this loan is for 20 years, or 240 months. Okay, so that's the loan that we'll be using in our demonstration. By the way, this is very typical of the types of deals we do. Again, all things being equal, we're going to only concentrate on buying this type of loan, and we'll keep the amount and terms on each loan the same. With that initial $200,000 investment, we are able to purchase 5 of these loans. However, we're going to pay just $40,000 per loan because we're buying it at a discount. Note that normally every loan and every discount is different. But again, for our illustration, we want to make the math model easy to follow, and so we're using very round and consistent numbers. We're also going to replicate this process a few times. We have our model loans that we bought with our $200,000 investment. We were able to buy 5 loans at $40,000 each because we bought them at a discount. This gives us a discounted unpaid principal balance, or UPB, of $5,000 for each loan. We start receiving monthly cash flow right away because we're buying performing loans. Our goal is to grow and buy more. This model works great in a self-directed retirement account, and also where people are looking to simply grow their wealth with cash flow. If you've ever seen an amortization schedule, and particularly if you've studied and really understand amortization schedules, you probably wish that you were the bank on every deal. I know I have. I remember buying my first house and seeing that total number of payments and realizing how much I was paying in interest compared to the actual amount financed. Those early payments are very heavily favored in the interest column. Let's look at the $386 payment. In the first month, the borrower makes his payment and $73 is paid towards principal and $312 is interest. So the unpaid balance goes down by about $73. The borrower still owes $44,926. The amount paid towards the principal out of each $386 payment increases just a little bit each month, while the interest amount goes down a little bit each month. Take a look at a 30-year mortgage. When you get to about 180 months or 15 years on a 30-year mortgage, that's about when it's somewhat equal, where half the payment is principal and half the payment is interest. The front half of a loan is much more valuable to a bank because it's very heavily weighted with interest. Keep in mind the amortization schedule and the amount that goes towards interest and how that relates to this 10-year model. So back to our demonstration, with all things being equal, we invested $200,000 and bought 5 loans at $40,000 each. Each note generates $386 per month for a total of $1,930 of passive income cash flow. How long do you think it will take for you to build up enough money to buy another loan for $40,000? Remember, that's discounted from $45,000. It will take 21 months to have $40,531. In less than 2 years, we're able to accumulate enough cash in our private bank to acquire a 6th loan. We've now increased our net worth by $45,000 because remember, we bought at a discount. So now we have 6 loans coming in, giving us passive income, and that monthly cash flow has increased to $2,316. Now, how long will it take to build up enough money to buy another note? In 18 months, you've accumulated another $41,689, enough to buy another loan. Now we buy our 7th loan, and our monthly cash flow becomes $2,702. Only about 3.5 years into this, and we now have 7 loan payments coming in when we started out with 5. The next one is only going to take about 16 months to accumulate $40,531, and we can now buy our 8th loan. As you can see, this is really all about setting it, forgetting it, and just letting it grow. It's a simple model. This graph represents the amount of cash flow coming in every month. The blue dots represent each time we buy another loan. As time goes by, you can see those dots get closer together. You can imagine as we continue along, it's going to grow even faster. So you start out receiving $1,900 a month, and then by the 10-year mark, you have $5,400 of monthly cash flow. This graph represents the unpaid balance, or UPB, of our loans that we bought. Now, it looks a little weird, like a stair step. It goes up, and then it slowly descends. Then stair steps up and descends again. This represents the combined unpaid balance of our loans. What I like about this is that you can see how much wealth you have created each time you purchase a note. The orange horizontal line represents our initial $200,000 investment. Notice that because we bought our notes at a discount, we actually start out with $225,000 of unpaid balance. The borrowers owe $225,000 on their mortgages, but we bought the notes for just $200,000. Okay, so notice the green lines are going down every month, ever so slightly. This represents the borrower paying down principal, so it goes down slightly each time they make a payment. By the end of the first 21 months, you can see that the unpaid balance is almost back down to the $200,000 marker. However, at this point, we've also accumulated enough cash to buy another loan, and the unpaid balance jumps back up another $45,000. The unpaid balance again starts to go down as the borrowers continue to make payments. And once we've accumulated enough cash to buy another loan, the unpaid balance goes back up again. Notice how the stair-step sections get smaller over time. In fact, by the time we get to 10 years, we have accumulated over $500,000 of unpaid balance. Remember, we started off with just $200,000 as our initial investment, so the growth is pretty significant. Even if we bought the note for just $1, the borrower still owes the full amount of the note, what they promised to pay, which is spelled out within the terms of the note. Now let's look at the cumulative cash graph. This is the cash that is in the bank. Imagine if you had a bank account getting all of this cash flow coming in from the loans you have purchased. Each of those $386 payments are deposited into your account. Once you reach the $40,000, you purchase another loan. When you purchase a loan, the cumulative cash goes back down. And just as we saw in the unpaid balance chart, the amount of time it takes to get back to $40,000 cumulative cash is shortened, allowing you to buy yet another loan. This is how you can massively grow your retirement accounts and grow the gains in a tax-preferred environment. So perhaps now you see another reason why we love notes. Without tenants and toilets, and without lifting a hammer, we have more than doubled our net worth in just 10 years' time by buying performing notes and letting the magic of compound interest do its thing. Now, what happens after year 10? It is highly likely that these notes will start paying off, that they won't go all the way to their 20-year term. The borrowers will either refinance or sell or somehow pay off the loan. Can we predict exactly when this will happen? No, but 7 years is the national average. And for this demonstration, we're just going to call it 10 years. There's actually less than a 1% chance that your 20-year note will go the full 20 years. So if it's a 20-year loan, it's probably not going to take that long to get a payday. And what happens when they pay off early? Well, your return actually gets better, sometimes a lot better. With the time value of money theory as it relates to note investing, your yield or return on investment becomes a lot sweeter because you didn't have to wait 20 years for the payday. Recall that 20 years is how your initial yield was calculated, but we don't know exactly when each note will pay off. Some loans might pay off in year 5, others in year 14. We once had a note pay off within 6 months of purchase. The national average payoff is in year 7, and in this demonstration, to keep things simple, we used year 10. How do we calculate the yield when they pay off early? That's actually a whole other discussion and using some different math. Let's just say if you were good with the 8% return when you bought the loan and it only gets better, then the short answer is it's good enough. For more information or to buy notes, contact us.